now let's get over a typical deal life cycle. So there's going to be the pre-acquisition period, the phase of pre-acquisitions. And then if they do succeed in the acquisition, there's going to be the holding period, which would be typically 3 to 7 years. Some people do say 4 to 6 years, but it all depends on the situations. And then lastly, there would be a phase where you have to sell your stakes and exit the investment. So on the pre-acquisition phase, what we usually do is we do the deal sourcing. Deal sourcing means we're looking for companies worth investment, so worth making an M&A investment. And sometimes we go directly to the target company. We find an attractive target. We go to the we go directly to the company and ask them if they have intentions to sell their stakes. It's like cold calling the target company, and of course it is, the probability is very low if we use that kind of method, but still it's worth a shot, and sometimes there are cases where they work, so they can be done. But in most cases, there are offers of investments from investment banks or accounting firms or other equity players. So there are gonna be a lot of ways for deal sourcing. And then if the target company does have an intention to sell their stakes, now there's gonna be some due diligence. There's gonna be a preliminary due diligence, and then a confirmatory due diligence once you're really sure that you're gonna go through this deal. And usually we do build a leverage buyout model in the preliminary due diligence process. So you get a quick look at how the returns are going to be. And then if you decide to proceed further, there are going to be much more deeper due diligences, working along with legal companies or consulting firms, accounting companies. You're looking at all aspects of the company so that you make a correct decision. And then there's going to be the bidding process where we did not address in this PowerPoint slide. It only happens when there are other bidders in the market. So the probability of going through all of these phases, like deal sourcing, all types of due diligences, and then we have to win the bid as well. So we have to be usually the highest bidder. The probability is very low. So if you're unlucky, and actually some of my friends or students who participated in our offline courses, even after 2 years of joining the firm, some of the students don't still have experience closing the deals. But on the other hand, some people, if they're lucky, they get to see deals as an intern as well. Yeah, but anyways, there are a lot of things to do, especially in the pre-acquisition phase. Especially if you're an analyst at a private equity firm. And then it's the holding period. You try to seek organic growth, so you try to seek EBITDA growth either by increasing revenue or reducing costs. As we've seen, that is one of the most important ways that LBOs create value. So these days, sometimes we pursue inorganic growth through a bolt-on strategy by exploring M&As with similar portfolio companies. So for example, if you'd acquired a car manufacturing company, maybe you can also acquire, if the PE has enough money, you can also acquire a car wheels manufacturing company and try to create a synergy between the two. Lastly, in the exit phase, selling the stakes to other strategic or financial investors is the most traditional method, and I think it's the most common method as well. But there are other options. For example, we have initial public offerings if the company that you have acquired is non-listed, or you can also exit the investment by dividend payouts. For the initial public offerings, what you're trying to do is you usually do it when it is tricky to find other strategic or financial investors. So for example, if your target is too big in size, maybe that can happen. Or if your target does not seem very attractive to other private equity firms or venture capitals, you make a public initial public offering, you go public, and you try to sell off the stakes in the public market. So in this case, you can't sell off your stakes 100% at once. Usually what you try to do is slowly sell the stakes, maybe 20% in the first year, another 20 to 30% the next year, slowly selling off the stakes. The problem with that is, number one, the stock prices might not be very attractive, especially when you're selling off your stakes. There's a lot of supply of that target stocks in the market, so obviously it's not very good for the stock price. Number two, because it extends your holding period. So if you just sell at this point, your holding period just stops here. But if you're selling off stakes slowly, your holding periods gets longer, and usually that's a negative factor to the internal rate of returns. However, on the other hand, if you're lucky or if something good happens to the target in the meantime, maybe the stock prices could go up, which could also increase your potential returns. And lastly, the dividend payout strategy. You're declaring dividends from the target, and if you're the owner of the target company, the dividends will eventually come to the private equity as profit. Or you can do a dividend recap where if you have repaid a portion of debt, now you have some more room for additional debt. So what you're trying to do is you pay a lot of dividends and raise additional debt to cover that payment. And that technique is called a dividend recap, where many companies, many private equities do choose to do as an exit strategy. However, this is also usually a second or third option because it's very hard to record high returns, and especially if your fund has a maturity of some type, it's very tricky and it's very difficult to exit by dividends. In terms of cash flow, usually in the pre-acquisition or deal closing process, you need funding for acquiring the company's shares. We're going to the uses table in our financial model. We also have to account for costs for due diligence, debt financing, and so on. So these kinds of cash outflows will occur before deal closing. During the holding period, there are going to be, we might need funding for bolt-on acquisitions, or these cases are not very often, but we might have to raise additional capital for target companies' financial distress. So in a in a unsuccessful deal where you cannot give up, you're seeing some kind of hope that the deal might turn around, you might inject some additional capital for the target company. And of course, if you choose to pay dividends, you might get a cash inflow. And remember that we also do have management fees regardless of the returns. So the private equity would profit from management fees. And lastly, on the exit stage, we will get cash inflows from selling stakes as a whole or as a partially in an IPO, or either by using a dividend recap technique. There's going to be a huge cash inflow usually upon exit. So this is a typical deal life cycle, which will be our areas of financial modeling in the LBO model.